Your gas price just changed. Not tomorrow, not next month, right now, while you're watching this, because the United States just took control of 50 million barrels of Venezuelan oil. And if you think this is just another headline about sanctions and diplomacy, you're missing what's actually happening beneath the surface. This isn't about Venezuela anymore. It's about who controls the valve when the world gets thirsty. It's about what happens when supply becomes a weapon instead of a commodity. And it's about a chain reaction that's already started in markets most people aren't even paying attention to. Now, I'm going to tell you exactly what this means for oil prices, but not yet, because if I give you the answer now, you won't understand why it's inevitable, you won't see the mechanism, and you definitely won't see it coming in your own life. By the end of this video, you'll see how three forces are colliding in a way that's only happened twice in the last 50 years. Each time it happened before, oil prices didn't just rise, they exploded, and each time most people were completely blindsided. But first, we need to talk about what happens when you remove that much supply from the global equation, because the number itself, 50 million barrels, doesn't tell you anything. And it starts with a pattern we've seen before. 50 million barrels. Let me put that in perspective. That's enough oil to fuel the entire United Kingdom for almost 2 months, or power every car in California for 6 weeks, or keep every airplane in North America flying for 3 weeks straight. Gone. Removed from free market circulation. Controlled. Now here's where it gets interesting, and this is the part most coverage is getting wrong. When the US seizes oil assets like this, it doesn't just affect Venezuela, it sends a signal to every other oil-producing nation watching. That signal? Your supply is only yours until it isn't. Think about that for a second. You're a country sitting on billions of barrels of oil. It's your natural resource, your sovereign asset, your economic lifeline. And then you watch another nation's oil get seized, controlled, redirected. Not because of war, not because of invasion, but because of political disagreement. What do? You start hedging, you start making backup plans, you start questioning whether the global oil market is actually a free market at all. You start wondering if your barrels are safe. And when nations start thinking that way, they behave differently. They cooperate less, they hoard more, they build alliances that have nothing to do with economics and everything to do with protection. But there's a more immediate effect happening right now in trading rooms from Houston to Singapore, and it has nothing to do with the actual barrels themselves. It has to do with perception, with fear, with the stories traders tell themselves about what might happen next. Stay with me. Because what happens in the next 72 hours in oil futures markets will tell us everything about the direction we're headed. Traders are already repositioning, hedge funds are already placing bets, and oil executives are already making phone calls you'll never hear about. But to understand where prices are actually going, and I'll show you the exact mechanism at the end, you need to know what happened the last time America made a move like this. The year was 2019. When the US sanctioned Venezuelan oil in 2019, analysts predicted chaos. Venezuelan production was already collapsing, from 3 million barrels a day down to less than 1 million. The country's oil infrastructure was crumbling, refineries were shutting down, workers were fleeing, the entire energy sector was in freefall. The math seemed simple: less supply equals higher prices. Except, that's not what happened. Oil prices actually stayed relatively stable for months. Some analysts celebrated. They said the market had absorbed the shock. They said global oil production was resilient enough to handle the loss. They were wrong. They just couldn't see what was actually happening beneath the surface. Because the market didn't just lose Venezuelan barrels, it gained something else entirely. American shale producers ramped up production. Saudi Arabia opened the taps wider. Russia increased exports to China and India. Iraq pushed output higher. The supply got replaced. On paper, everything looked fine. The barrels were still flowing. Prices stayed manageable. Crisis averted. But here's the hidden consequence everyone missed at the time, and it's the same trap we're walking into right now. When you replace light, sweet Venezuelan crude with heavier, sourer alternatives from other sources, you don't just swap barrels, you change the entire refining equation. Venezuelan crude is some of the best quality oil in the world. It's easy to refine. It produces more gasoline per barrel. It's what refineries, especially in the U.S. Gulf Coast, are specifically designed to process. When you replace that with heavier crude from Canada or Mexico or Saudi Arabia, refineries have to work harder. They have to adjust their processes. They create bottlenecks, inefficiencies. The global spare capacity cushion, the amount of oil producers can quickly add to markets if needed, is now at its thinnest level in decades. There's no slack in the system. In 2019, OPEC had room to increase production by nearly 3 million barrels per day if they needed to stabilize prices. Today, that number is closer to 1 million, maybe less. And most of that capacity is in Saudi Arabia and the UAE, which we'll come back to in a moment. American shale, which rode to the rescue last time, is facing completely different conditions now. Investors who dumped money into shale during the 2010s got burned badly. They watched companies drill like crazy, produce tons of oil, and somehow still lose money year after year. And those inefficiencies, they don't show up in price immediately, they show up later. Gradually, like pressure building in a pipe, like a crack forming in a dam. By late 2019 and into 2020, those inefficiencies started manifesting. Refinery margins got squeezed, processing costs increased. The crack spread, the difference between crude oil prices and refined product prices, started widening in ways that hurt consumers. But then the pandemic hit and everything got scrambled. Oil prices crashed, demand collapsed, and everyone forgot about the structural problems that were already forming. Which brings us back to those 50 million barrels the U.S. just seized, because this time, there's a critical difference that makes the price trajectory completely opposite to what happened in 2019. This time, there's nowhere for the replacement to come from. Now those same investors are demanding discipline, restraint, profits over production growth. The replacement cavalry isn't coming. So what happens when you remove 50 million barrels from a market that's already running on fumes? A market where there's no backup plan, where there's no emergency reserve of production ready to flow at a moment's notice. This is the first piece of the puzzle, the supply constraint, and it's creating conditions we haven't seen since the oil shocks of the 1970s, when spare capacity evaporated and prices quadrupled almost overnight. But supply is only 1/3 of the equation that determines where prices go from here. And honestly, it might not even be the most important piece. The second piece is happening on the demand side, and it's moving in exactly the wrong direction. While everyone watches supply, demand is quietly setting a trap. China just posted its strongest manufacturing data in 8 months. Factories are humming again. Production lines are running at capacity. And when Chinese factories are busy, they consume massive amounts of oil, not just for energy, but for petrochemicals, plastics, industrial processes. India's oil consumption is growing at rates not seen since before the pandemic. The country is adding cars to its roads at a pace that would shock most people. Air travel is hitting all-time highs globally. People are flying more than ever. Airlines are ordering new planes. Routes are expanding. The world is using more oil right now, today, this minute. And here's the kicker. This increased demand is happening at the exact moment the U.S. just tightened the supply noose by controlling Venezuelan barrels. Think about the timing. We're entering the spring and summer driving season in the Northern Hemisphere. Demand for gasoline traditionally spikes. Refineries typically ramp up production to meet that demand. But this year, they're doing it with less crude variety to work with tighter supply, with less room for error. Now, I know what you're thinking. Won't the U.S. just sell those 50 million barrels and stabilize the market? Won't they release that oil when prices start climbing? Isn't that the logical move? Maybe, eventually. Possibly. But here's what history tells us about seized oil assets. They become political tools, not market stabilizers. During the Iranian sanctions era, seized oil sat in tankers for months, sometimes years, while diplomats negotiated. The oil existed, it was physically there, but it might as well have been on Mars for all the good it did the market. Because once oil becomes a bargaining chip in geopolitical negotiations, its release depends on political timelines, not economic ones. It depends on leverage and concessions and diplomatic wins, not on whether consumers need cheaper gas. Every day that oil sits controlled instead of flowing freely is another day the market operates without it. Every week is another week refineries adjust to its absence. Every month is another month demand builds while supply stays constrained. Tension builds, pressure accumulates, and there's a specific moment in market psychology we need to talk about, a tipping point that historically determines not just whether prices rise, but whether they explode. Because it's not really about the physical barrels at all.
It's about what traders believe might happen next, and that belief is starting to crystallize right now.
In oil markets, there's a concept called the fear premium. It works like this. When traders believe supply could be disrupted, not is disrupted right now, but could be disrupted soon, they start bidding prices up preemptively. They buy futures contracts, they stockpile, they hedge against worst-case scenarios. And in doing so, they create the very price spike they're trying to protect against. It becomes a self-fulfilling prophecy. We saw it in 1979 during the Iranian Revolution. Iranian production dropped, spare capacity was low, and traders panicked. Prices didn't just rise, they tripled in 18 months. We saw it in 1990 when Iraq invaded Kuwait. Both countries' production went offline. Traders feared Saudi Arabia might be next. Prices doubled in weeks. We saw it in 2022 when Russia invaded Ukraine. Russian oil kept flowing to most of the world, but the fear of disruption sent prices to levels not seen in over a decade. The pattern is always the same. A major supply holder gets removed or threatened, spare capacity is already low, and suddenly every trader in the world starts pricing in worst-case scenarios. Not what is happening now, but what could happen next.
And here's the uncomfortable truth. We are standing at that exact precipice right now. The U.S. controlling 50 million Venezuelan barrels, combined with thin spare capacity, combined with rising global demand, these are the exact three ingredients that have triggered fear premiums every single time they've appeared together in the past 50 years. No exceptions. Every single time. But there's one more element, the accelerant that determines whether prices rise gradually or violently. Whether we see a 20% increase over a year or a 50% spike in 3 months. And it has everything to do with trust. When the U.S. seizes oil assets, other nations watch closely. Venezuela isn't just losing barrels, it's losing sovereignty over its primary resource. And that sends a message to every oil-producing nation that isn't perfectly aligned with Washington. What do you do if you're Saudi Arabia watching this? You've been a U.S. ally for decades, but you've also been diversifying. Talking to China, building relationships with Russia, exploring options. And now you watch Venezuela's oil get seized, not in a war, not through military action, through legal mechanisms and political pressure. You start thinking, could that happen to us if we make the wrong move? If we push back on U.S. interests at the wrong time? Or what if you're the UAE or Kuwait, or even countries outside the Middle East, Nigeria, Angola, Brazil? You start thinking about leverage, insurance policies, ways to protect your own supply from similar moves. And historically, that thinking leads to one place, reduced cooperation with U.S.-led market stabilization efforts. Think back to 2018. Trump publicly pressured Saudi Arabia to increase production to lower prices before midterm elections. And they did. They opened the taps. Prices fell. The U.S. got what it wanted. Would that happen today, after watching oil assets get seized and controlled for political purposes? That compliance is no longer guaranteed. In fact, there's evidence it's already eroding. Saudi Arabia and Russia have been coordinating production cuts despite U.S. pressure to increase output. OPEC+, the alliance between OPEC and Russia-led producers, is becoming more assertive, not less. The implicit deal that stabilized oil markets for decades was simple. Producing nations keep oil flowing, and in return, the market stays mostly free, and their property rights stay mostly respected. But when oil becomes a tool of statecraft, when barrels get seized as political leverage, that deal starts breaking down. And when it breaks down, the very mechanism we've relied on to keep oil prices stable during disruptions, cooperative production management, might not be there when we need it most. Which brings us, finally, to the question I promised to answer at the beginning. What does this actually mean for oil prices? Here's what the pattern tells us, based on every comparable scenario in the last 50 years.
When supply gets restricted in a tight market, when demand is rising, when spare capacity is minimal, and when geopolitical trust erodes, prices don't just go up gradually, they jump, then they swing violently, then they settle at a new, higher baseline. Not next year, not eventually, not in the long term, within weeks to months. Based on every comparable scenario where these three forces aligned, 1973, 1979, 1990, 2008, and 2022, we're looking at price increases between 20 and 40% from current levels in the next quarter. Not speculation, pattern recognition. The 50 million barrels the U.S. now controls aren't just oil, they're a lit match in a room filling with fumes. The explosion might not happen today, might not happen this week, but every day those barrels stay controlled instead of flowing, every day spare capacity stays tight, every day demand keeps rising, the pressure builds, and when it releases, it won't be gentle. You'll see it first at the pump, then in your utility bills, then in the price of everything that needs to be transported, which is basically everything. But here's what you need to understand about what happens after that. This isn't really about Venezuela anymore. It never was. It's about what happens when the world's largest oil consumer decides it can unilaterally control supply that belongs to other nations. Because once that precedent is set, once that line is crossed, the entire architecture of global oil markets changes. Not might change, changes. Other producing nations adjust their behavior. They build alternative systems. They create backup plans that don't involve U.S. markets or U.S. dollars or U.S. approval. And in the transition, in that messy period where the old system is breaking down and the new one hasn't fully formed, markets become volatile, unpredictable, dangerous. Your gas price already changed. The mechanisms are already in motion. The traders already see it coming. You just don't see it at the pump yet. But you will. If this analysis helped you understand what's really happening in oil markets and what's coming next, subscribe now, because this story is just beginning. The next phase, when these price increases actually hit, when nations start retaliating, when the new oil order starts taking shape, is going to catch most people completely off guard. But you'll see it coming.